Hi everybody. It's Larry Kotlikoff back with Economics Matters, the podcast. I'm delighted to have my very young but also very old friend Richard Berner with us today to discuss the financial system, the financial markets, the new administration's policy, whether we have anything to worry about in terms of the stability of the financial system, given all the uh, let's say, turnover in terms of the regulatory apparatus, the folks in charge of overseeing our financial system, a new Treasury Secretary. Uh, but let me give you a brief background on Dick's really glorious career here. Right now, he's had this huge number of truly important positions. Right now, he's the clinical professor of management practice in the Department of Finance. And with Rob Engle, he's the co-director of the Stern Volatility and Risk Institute. So he's in the Department of Finance at the Stern School of Business at NYU. That's the Leonard N. Stern School of Business. Dick served as the first director of the Office of Financial Research. That's the OFR from 2013 until 2017. This was set up under Dodd-Frank. It's a regulatory authority to try and keep track of our financial system and whether we're to keep the government ahead of the curve so it can spot parts of the financial system that are in trouble of imploding and thereby bringing down the rest of the financial enterprise. He was a counselor to the Secretary of Treasury from 2011 to 2013. He's been the managing director, chief U.S. economist, and chief U.S. economist at Morgan Stanley. He did that from 1999 through 2011, and he's the co-head of global, and he was also the co-head of global economics at Morgan Stanley from 2008 to 2011. And then I want you, Dick, to rather than me going on for like another hour about your vita here, I want you to start with where you were born and how you got into economics and finance and where you went to school and what degrees you got. And just tell us about your entire career, okay? But I do
Well,
it in 5 minutes, okay?
less than that, Larry. Thanks. First, thanks
Sure.
for the opportunity to have a chat with you. It's great to catch up with you. We've known each other for a long time, and I always benefit from learning from you and tapping your wisdom. So I hope the experience is
Absolutely
a
mutual.
mutual one.
Yeah.
Um, I grew up in Brookline, Massachusetts, and being a Bostonian, culturally, I always felt that it was really important uh, to exercise your responsibilities to society as well as to, try to find happiness in life. And my mom was particularly, inspirational in that regard. Uh, she had me knocking on doors in the presidential election in 1952.
Wow.
Um, when I was 6 years old, and taught me the importance of, being involved as a citizen and thinking about public service as something that was a noble undertaking. So I think that sort of is something that I came by naturally, and both my parents really supported that, and I tried to think about those issues and how I could do that uh, as I as I grew up and as I entered into higher education. Um, I actually started in college as a physics major because I had an uncle who was an electrical engineer and a physicist, and admired him and was interested in it. And I quickly realized that that was not something that was going to be a really terrific career path for me. Not just because others were better at it than I was, but also because my passion lay more towards making people's lives better. And so I came into economics for that reason. I really, from being a teenager when I guess I was 10 years old when the European Common Market was started, and I got interested in, why were they doing this and why was it important? What did it mean for Europe? I studied European history and thought about how this represented a real change that was aimed not just to create economic benefits, but also to create political benefits that would prevent European countries from fighting with each other after the Second World War again. And that kind of stuck with me, and so much so that when it came to writing a senior thesis in college,
This was not just any old college. This was Harvard University, right?
this was Harvard College, right? And then at the University of Pennsylvania, I wrote my PhD thesis on a related topic on the European experiment. I was very privileged as an undergraduate to have a professor who became a Nobel Prize winner as my mentor, and likewise, that was Vasily Leontiev. And likewise, when I was in grad school, Lawrence Klein was my thesis advisor, and he subsequently was awarded the Nobel Prize for their work in economics. And they one common characteristic they had was their willingness to take time to help students like me learn, and that kind of stuck with me as part of life's responsibilities. So um, after grad school, well, I got a fellowship actually to work on my thesis and go to Europe and really learn about it firsthand, and came back and finished the thesis. But in the meantime, got a job at the Fed. One of my other advisors was a guy who went to the Fed and persuaded me that'd be a good place to go, and worked on international economics and international finance there.
Okay.
That was just about the time when we got off the gold standard and went to floating exchange rates um,
We're
in the
talking
early 70s.
70s. So you recall who the guy was at the Fed?
Sure. Dale Henderson,
Oh,
um,
I was,
who,
what year were you there? Because I was an intern with Dale from when I was in grad school. Dale had this great group, Michael Dooley, all these fantastic
yeah,
economists.
absolutely. They were my colleagues.
Oh, so you must have left right before I went there for the summer.
Well,
But
I left the Fed um, in 1980. I had gone from international finance to the more domestic policy arena, and worked in that area for about 4 years.
that's weird because I was there in like 76, 75 for summer. Maybe, I don't know why we didn't connect there, but we
Don't.
were in Watergate at the point.
Yeah, exactly. That's where we were.
Jesus, I don't know.
Maybe our memories are faulty at this stage of our lives, Larry. Maybe we actually did see each other and
I
just
don't,
aren't remembering it.
yeah.
Um, but both those years at the Fed were a great experience because there was a lot going on. It was the period during which inflation rose a lot, and during which we had a variety of leaders at the Fed, some of whom really cared about inflation, others less so. Um, and we were all very inspired in 1979 when Paul Volcker came in to be chair. And that energized us as a group, because I think the staff at the Fed was a little disheartened by the inflation developments that were unfolding in the U.S. economy, and for which we felt responsibility. And so, Volcker's coming in was really a turning point in that regard, and it just inspired all of us.
Yeah.
Um, and I left the Fed uh, because my thesis advisor asked me if I would help start a policy shop in Washington, where we would take the work that he did and try to analyze policies and serve our clients doing that. That worked for a couple of years. After which I got a call to to go to Wall Street and be an economist at Morgan Guaranty Trust Company of New York, from friends of mine with whom I'd worked at the Fed. Steve Roach, Jim Freilich, both did that. And from there, I was at Morgan, then I went to Solomon Brothers to work with Henry Kaufman, who still is a good friend and mentor. In fact, I'm having lunch with him tomorrow.
Wow.
And at 97 years old, he's just as sharp
Ask him if
as.
he'd like to be on the podcast.
Well, maybe he would do that.
Yeah.
But he's still very sharp,
Mhm.
and a terrific guy, and has been a strong supporter of the institution where I now am, at Stern. And he persuaded the leadership at Stern to add to the curriculum a financial history offering and a chair in financial history. The old statement that if you don't remember history, then you're probably going to be condemned to repeat it, is something we believe in, and that's true for financial history as well as other aspects of it.
Yeah.
I ended up spending 12 years at Morgan Stanley. At each of these places, I learned a heck of a lot. I have a degree, a PhD in economics, but not in finance, but I learned a lot of finance in 30 years in the industry. And in 2011, after the financial crisis and after Dodd-Frank was passed, the secretary, whom I'd gotten to know, called me and said, "Are you interested in helping out with this?" And I said, "Sure." Only for a limited period of time. I figured it might be 2 years, and then we'd do it. But he looked at me and said, "We want you to run this new office, and to set it up and run it and get it going." And I was a little reluctant at first. It was a big commitment and a lot of work. And one of the things he said to me still sticks with me. He said, "I want to make sure you understand that there's no risk of affirmation in these jobs." I said, I get that. Um, and I did it. I set it up. It still exists today, and I think they're doing good work. So I feel some pride of some paternal pride in having done that.
So just tell everybody a little bit about the OFR, the Office of Financial Research.
So it was set up under Dodd-Frank, and the Dodd-Frank
Yes.
law was passed to make our financial system more resilient in the wake of the financial crisis. Because what we learned from the financial crisis are two very important things. One is inherently the financial system has vulnerabilities in it, and we can address those by making the system more resilient, both by, if you will, adding some shock absorbers to it so it doesn't break, and second, by creating incentives to help get people do more of the right thing than the wrong thing. So I'd call those guardrails, and both of those things were embedded in the Dodd-Frank Act. In order to implement a lot of these things, the framers recognized that they had to improve the quality, scope, and accessibility of our financial data, and that was one of the prime responsibilities of the OFR. In addition, a responsibility was to assess threats to the financial system across the system. And that's really the second thing that we learned. We learned that we couldn't approach this in a piecemeal way. And that still is a lesson that needs to be emphasized and learned when we think about what's going on in the financial system today, because it's a connected system, an interconnected system, both within borders and across, asset types and across institutions, across markets.
Well, let me ask you this question then. If the OFR was in place in 2000, let's say seven, what early warning signals would you have gotten that were not received back then that said like financial crisis is coming in 2008? Is that a fair question?
It's a very fair question. And, there are no guarantees in life.
Yeah.
But to your point, I think that we would have had better information. A simple example of that is when people were exposed to Lehman Brothers, they often didn't know that because they were really engaged with a subsidiary of Lehman that had nothing about Lehman in its name. Had they known that Lehman was the parent and that they were dealing with a subsidiary, and the concerns about Lehman Brothers were much better advertised than many of its subsidiaries. Early in 2007, for example, being on the front lines of that at Morgan Stanley at the time, people at Morgan Stanley were not terribly interested in doing business with Lehman, but they didn't know about all the hundreds of subsidiaries who were exposed implicitly or explicitly to the parent company in one way or another. The work that the OFR did was in establishing identifiers to understand those linkages and to gather and collect data that would help quantify what those linkages look like. So you could see where the vulnerabilities were, and you could see how the shocks that
Would
occurred
spread.
would expose them
And how it spread through the system, right?
and spread through the system.
Was it?
So, you probably remember back in 2007, housing stocks went down and the value of mortgages went down because people had taken off way too much risk in and offered too much risk in lending. And we would have known more about those things. Again, wouldn't have been perfect, but we would have had some early warning signals that we just didn't have because the information was just not there. The system was opaque. The interconnectedness was not apparent to people. And so people thought when there was a housing problem that it was limited to housing. And I can remember conversations that I had with officials at the time, both in the United States and elsewhere, where they thought this was something that would be contained. In fact, for all of his wisdom and competence, Ben Bernanke made statements like that at the time. And obviously that proved not to be the case. One of the key issues that arose in the financial crisis was the issue of liquidity risk. When people needed to sell assets, but they couldn't do it without triggering further declines in the price of those assets in what would be called a fire sale, because nobody was willing to bid for those assets given the uncertainty. So what we learned about liquidity risk is that in good times, it's the lubricant that makes the financial system work. In stressful times, when it dries up, it kind of jams up the financial system. And based on my experience of that time and subsequently, I've made it my priority to work more on liquidity risk to try to understand why it doesn't work in stress periods and how to analyze that. And I'm engaged in a project right now to further that research.
So Dick, since we're on this topic, let me just ask you, I wrote a paper called, that's on my website, kotlikoff.net, called The Big Con, which I look back at all the arguments for why the Great Recession occurred, that the Financial Crisis Inquiry Commission, the FCIC, put forth
Yep.
in the document. There are like 10 reasons, or main reasons. And I looked at that 10 years or so, 15 years later with the data that had been accumulated, studies have been done, and everything they said was the cause, all the data disproved, it seemed. At least you'll see, if you want to look at that article, it's and this was spurred on in my thinking by a conversation I had with Tim Geithner, the former Treasury Secretary. We happened to be both speaking at a conference in Korea, and Geithner, of course, is a much more important figure than me. And he was having lunch they put him in a very fancy top floor room to have lunch, and they had nobody to have lunch with. So they said, "Could you go have lunch with Tim Geithner?" I said, "Sure." So I said,
What year was this, Larry?
"Oh, I don't know. Many years after he was Treasury. It was after he was Treasury Secretary."
Okay. He was my boss at Treasury.
Oh, okay. So we had a fun lunch, and the thing he was one of the things he was pointing out was that the Maiden Lane Fund, which when J.P. Morgan purchased, as
Bear
you
Stearns.
Bear Stearns, the Fed had to, in effect, bribe, my language, J.P. Morgan to buy Bear Stearns by
Right.
taking off Bear Stearns' books something like $31 billion worth of supposedly the worst subprime mortgages they had.
Yep.
And so the Treasury and the main lane, people don't know, but is the street right behind the Federal Reserve Bank of New York. So the kind of inside joke is that this was the rear end of the Federal Reserve. They're taking, the excrement of Bear Stearns and into the Federal Reserve Bank of New York. And this fund, Geithner was pointing out, when they sold it, maybe 5, 10 years later, whatever it was, whenever we met, maybe it was 7 years, had made a profit. Even
Hmm.
it had gone through the Great Recession, and you would have expected these things that had been rated so poorly to so low at the time and were valued so at such a low valuation to have failed. They actually made money for the Fed, and that raised the question to me of whether the entire episode was essentially panic. And then if you look back at the history of recessions in our country, a large fraction of them, I think it's over half, have the word crisis or panic in their names, in their title. So so my view is that whenever you have a leveraged system like we have, uh, it's fundamentally vulnerable to panic. And yes, you can kind of cut that off a little bit at the pass, but whether you can really stop a panic, you can stop somebody screaming, uh, getting people to run inside a crowded theater when somebody screams fire when there's no fire. I don't know if you can really do that. But
Well, I think that's entirely consistent with what I'm talking about.
okay, I agree.
Because
Yeah.
and it aligns with the liquidity issues that I've been discussing in a broad sense. And the reason is that when people have assets on their books, I mean, intermediaries like Bear Stearns or Morgan Stanley or whoever banks, they all perform the function of financial intermediation, which brings together borrowers and and lenders. They could be the lender or they act as agent for investors or lenders. The investors expect to earn a return on their investment, but we all know that asset values fluctuate. And if the assets were overvalued to begin with, which in many cases the mortgages were, and they were destined to go bust because there was too much leverage. I mean, just think about it. If you had a mortgage that was made at 120% of the value of the collateral, and the collateral, that is the house, the collateral was overvalued to begin with, then it's pretty clear that the incentive of the borrower is to default on that mortgage because they can't. Why should they repay? Why shouldn't they just put it back to the lender, who is going to be on the hook for the loss? The losses were there to begin with if it was over 100% loan to value, but they went further than that. And so when the value of the houses declined, um, that made the problem worse. And people couldn't possibly pay. They were misled and defrauded by the people who lent them the money, saying you're going to be able to refinance this at lower rates and home values are going to go up and all those fairy dust things. And that's an ingredient in this problem too. But the vulnerability that you pointed out is that there was way too much leverage. There was way too much risk taking. And financial panics are caused by the combination of bad risk management, too much risk taking, too much leverage, and not paying attention to the ability to exit a position when times get tough. And when times get tough, liquidity dries up and people can't sell the things they need to sell. And it turns out they sell what they can. So if they had a mortgage and they had a treasury bill, they'd sell the treasury bill to raise cash because that's much more liquid than the mortgage. But they're
So
still stuck with the mortgage.
yes, so my argument in this paper, The Big Con, and it's kind of, I chose that title because there was this movie, The Big Short,
Yeah,
and
I'm very
the
familiar with the movie and the
yeah,
people in it.
yeah, and I thought that was a big con. My claim is that the facts of the leverage and uh, the degree of malfeasance in the system and the under the notion that all these securities were being underrated and there was inside rating. All these allegations that was the FCIC made were not necessarily were not supported by the facts once the economists have really dug into those years later. So my concern is that I'm not saying that there wasn't enough there to tell a lot of good stories and to have a great book and to have a great movie and to convince the entire public that at the time and these stories were there and the press were focused on it, but uh, was this really in the end of the day more than just a panic that could have happened? Uh, you
The
know,
panic was the symptom. The cause was the things we just talked about.
okay, so I'm
And
thinking the other way around. I'm thinking it's the panic was the cause, and these other things were the stories that were. I mean, look, if you look at the Great Depression, the crash in '29, there were a lot of stories leading up to the crash uh, about swampland being sold in Florida. If you look at some of the other panics, there's always something that touches them all. It's a railroad, some railroad magnet goes under, or somebody is trying to corner some market, maybe I think 1909 panic. I think it was somebody trying to corner the copper market. There's always something major something that gets attention, that gets too much attention, and everybody decides it's time to sell, and then things go down the tubes. Now,
fine, but
I spent,
that's why I think our stories are very consistent because those events are simply the catalyst they're the shocks that expose those vulnerabilities across the system, right?
yeah,
Everything seems to work fine as long as the most important five-letter word in finance is satisfied. That word is trust. If people trust that they can get paid back with maybe a return
yeah.
for their investment, then they'll take the risk, right? And the big question for a risk manager is, am I getting paid for the risk I'm taking?
Yeah.
And people thought that they were. But every once in a while, people take risks that are completely unwarranted and they add leverage. They take too much risk. They don't understand how to manage the risks. And
Yeah.
those things are fundamental to finance.
So
And
yeah,
and just let me say one more thing. Let's take another example which had mild consequences by comparison to the global financial crisis. Take the banking panic of 2 years ago, right? There was a panic there. Why was there a panic? There was a panic in some institutions because they failed to manage their risk. They took on too much leverage. The liability side of their balance sheets was largely uninsured deposits, which, because they were uninsured, people just yanked out when they didn't trust the value of the institution and its safety and soundness. And because the supervisors involved completely failed at their job. Think about supervision as, it's like the cop on the beat. You've got regulations that tell people what they're supposed to be doing to ensure safety and soundness. You've got the supervisors who make sure that they're doing those things, that they have good governance around their risk management, that their board is aware of what they're doing and how they're running the business. They're well specified and not very complicated criteria for thinking about how a financial institution should run itself and manage its risk so that it can, if there are problems, they will survive and they will ultimately thrive. Because that's what we want in our society. We want institutions who can earn a return on their investment while helping others finance theirs. If they can't do that, then the system is not going to function. And when people lose trust in the ability of institutions or the whole system to do that, then you have a panic. And it's that moment when Knickerbocker Trust, for example, in 1907 failed, that Bob Berner, I'm sure you've read his book on the panic of 1907. That was the trigger that led to the problem. But the problem was that there were all kinds of vulnerabilities in the financial system, and there was very little supervision. And we didn't have a central bank at that. That panic is one of the things that led to the establishment of the Federal Reserve System.
So, if we go back to when you were still the OFR, you had this conference, you invited me to come and speak about limited purpose banking, where I
Yep.
was talking about getting the leverage out of the financial system because I don't
Yep.
see any real economic goal reason for it except to produce a multiple equilibria potential for panic-driven financial collapse. So I think we can have a banking system that looks more like mutual fund, that's equity finance mutual
We
fund
could.
banking. But anyway, let us move from, your my history on this stuff and discussions, and I think we do agree pretty much 100% on what the dream solution would be and what the reality is, and
I don't know what the dream solution would be.
okay,
I
well, at least
I know what
my
I
dream.
know what some areas that for improvement are.
Yeah. Okay. So
Um,
my dream solution, but let's talk about today, and let's talk about
yeah.
Trump administration. Let's talk about whether the uh, what seems to be folks taking a sledgehammer to regulatory bodies, to federal governmental bodies throughout the system,
Yep.
whether we're talking about Social Security, whether we're talking about the CIA, the FBI, the Justice Department,
Right.
the Offices of Personal Management. What's happening with the regulatory system when it comes to financial matters under this administration? Are you concerned?
I'm very concerned. Look, let's go back to why we have regulation in the first place. We have regulation because markets fail, and because social and private costs don't align with each other. And when there are distortions like that, and that's economist jargon, obviously, but when there are distortions like that, and people take advantage of the system and can defraud others, then it's the responsibility of government to establish some rules of the game. So there are five things that I think that are the establish the need for financial regulation. We want to protect consumers, we want to protect investors, we want to make sure that markets are fair and efficient so that people don't get ripped off by transacting and they trust the markets in which they engage. We want to assure, if we can, financial stability. A little bit of what we talked about a moment ago. And last, we want to prevent financial crime because the financial system can be used for all kinds of illicit activity, most of which we think is criminal, like drug running or human trafficking or money laundering to finance other criminal activity. And there's plenty of that, by the way. That's $2 trillion annually of money laundering activity that really most of which goes untracked, and which in this country it's the Treasury's responsibility to try to track down the the criminals and to try to protect the financial system from being abused and misused by those people. So those are important regulations, and a couple of things are really important. There's a natural tension between those goals and the people who are subject to the regulation. Many of them think that because the regulation is not costless. Let's be honest with each other. It does have a cost. The question is whether the costs are worth the benefits that it provides. To society, the costs fall on the institution, but the benefits are enjoyed by society. But they're not just enjoyed by the society, they're enjoyed by the institution because, once again, if people trust the safety and soundness of JP Morgan or whatever the institution is, they're going to do business with them. If they don't, they won't. So
Right.
there are huge benefits for the industry and for the components of the industry, the firms in it, and the markets to function in it that are enjoyed by society, but that are also enjoyed by the institutions and the consumers. That's the theory. Does it work? Yeah, I think it generally speaking, it works. But there's a tendency sometimes for regulation to go overboard and to become cumbersome and to become complicated. And a good example of that, I think, is what the Federal Reserve tried to do in what was called the Basel III Endgame, which was the completion of a long series of regulatory reforms that would have boosted capital requirements on U.S. firms, that would have involved a whole bunch of other regulations that some of which mattered to some extent. The question was, again, was the burden, was the cost worth the benefit that these regulations would promote? Part of the problem here is that the Federal Reserve did not do any analytical studies, did not do the analysis and the data mining that was necessary in order to establish that trade-off. Were the costs going to be offset by greater benefits? They just said, this is what we got to do. And so it made them an easy target for the industry to say, look, we've been changing our way of doing business since the global financial crisis. Our capital requirements have gone up in actuality almost tenfold. We are now much more resilient in the banking industry. What has happened, however, in the interim is the rest of the financial system has grown dramatically, in part because, like water seeking its own level, people are seeking to locate economic and financial activity outside the banking system to find places that are less well regulated. But what we've learned is that those are not separate from the banking system. They're highly interconnected with the banking system. The banks provide them with credit, with leverage, with liquidity. And indeed, what we're seeing now in parts of the financial system is with private credit, for example. They're taking assets off the books of the balance sheets of banks to reduce their capital requirements. That's okay in peacetime. The question is, are we accounting for all that and looking at it holistically in any way, shape, or form? I think the answer is no. So the growth of these so-called non-bank financial institutions in general and private credit in particular, where they are opaque, we don't have much information about them. We don't know where the risks are. We can only start to guess at that. This kind of sets us back to where we were in some ways before the financial crisis. Once again, it would be the job of the Office of Financial Research, among others, to get more information about these. The IMF came out in April of last year with a chapter in their financial stability report on this topic. And they said one of the answers is to get more disclosure, have more information about these guys. And anytime they see disclosure, they say, no, we don't want that. Transparency is not our friend. We're not interested in having more burdensome regulation. The whole point you guys don't get is it's all fine because we know how to manage our risk. We're less leveraged. We don't take as much leverage as the banks. We know how to manage these risks. And look, have we ever had a blow up? That's always one of the criteria that you see is people saying, have we ever had a blow up of this before? Well, when you uncover vulnerabilities, you need to say to yourself, this could happen. And we need to look into this to see whether or not it could create problems for the financial system. So that's a long way of saying, the system is changing in response in part to regulation. It's changing in response to innovation, which is, can be a really good thing. It can reduce costs, it can reduce risk, it can bring benefits to consumers, new financial products. Why would that not be good? That could be good. But in order to understand whether there are also risks attached to it, we need to take a look at what those risks might be and to think about where they're going. And that's one of the big lessons from the financial crisis of 15 years ago.
So what do you see happening in terms of actual policy right now that makes you worried?
Well, the pendulum has swung from the overregulation that was embodied in Basel III Endgame to take the industry's argument that they're overregulated and overburdened and to change the whole dynamic of regulation. And nowhere is that more apparent than in digital finance and cryptocurrencies, where we don't have any regulations at the moment. The industry is saying, yeah, sure, we need regulation. But what they're also saying is we want regulation that is favorable to us. And this administration is, saying that there's way too much regulation, that if we deregulate our economy, then we're going to see all kinds of wonderful things happen, more growth, more opportunities for people. In certain cases, that could be true. But in other cases, it may undermine trust. It may undermine the functioning of the economy and the financial system to the detriment of people who are engaged
So
in
you're
those
thinking about
activities.
maybe, let's take an extreme case. JP Morgan is allowed to and does decide to start investing in Bitcoin, or one of the 20,000 cryptocurrencies. Maybe it's the Trump meme coin. And you know, maybe that's not a diversified, maybe they have too much in there and they lose it. And there's a crisis, just like what is FTX crisis, where the valuation goes down to zero because there's been some fraud practiced, and now JP Morgan loses a chunk of its assets. Now there's a run on the JP Morgan in effect, or that's an extreme case because JP Morgan's the biggest bank in the world. But if we're talking about,
and they're very well capitalized and very well managed, so they can afford to lose money.
Yeah, but if we're talking about like a Silicon Valley bank or a medium-sized bank, it's significant, that did go under, that could trigger panic. That could trigger. We have about, as I understand, about 7 trillion of uninsured deposits out of about 17 trillion that are.
Yeah, it's about 40%. That's right.
Yeah, and that's a lot of that probably is parked outside of the big money central banks, whatever, money center banks.
Yep.
So that right there is a huge potential for
that's a vulnerability
for that money leaves, and then the FDIC is doesn't have the funds to really insure the insured deposits, let alone cover the insured deposits.
So there's a proposal to address that vulnerability.
Okay.
And it's been put out by several people, including the G30, including me, and things that I've written. And what is involved is saying, look, it's okay if you have uninsured deposits, but we want to create incentives and some backstop, if you will, that you pay for to guard against the runs on those deposits. We're going to ask you to reposition collateral at the Federal Reserve directly proportional to your share of uninsured deposits. And so if those deposits run out the door, that collateral can serve as a funding vehicle for you, right? Now, it's costly to position that collateral at the Fed because it's not going to earn a return.
Right.
And so that creates an incentive for people not to use uninsured deposits to excess. The less uninsured deposits you have, the less collateral you have to post to the Fed, the more you have opportunities to earn a return on your balance sheet. So there's an incentive that to me makes a lot of sense. And that floats up and down at the discretion of the institution rather than being at the discretion of the regulator. They can decide what they want to do with their money, but they need to do it in a way that doesn't put a burden on the taxpayer. And that relates to incentives, Larry, because your proposal for narrow banking addresses one of those things, which is the too big to fail problem. If you have narrow banks, and all they do is serve as a deposit repository, and that's backed up, as you say, analogous to money funds by high quality collateral, and they're not lending out money and engaging in credit transformation, liquidity transformation, and maturity transformation, then that can be very stable. Does it serve all the needs we have in the financial system? No, but we could have other institutions, and we do, who take more risk and, who don't put the taxpayer at risk. So can we embed that kind of thinking into our banking system? Well, I think that what I just mentioned is one of the ways to make the system safer and to create incentives for the institutions to do the right thing.
That's a step towards a very big step towards limited purpose banking.
Yeah.
And it goes back to Irving Fisher and Frank Knight in the 30s, responding to a third of the banks failed in the 30s.
Yep.
They were talking about 100% reserve banking, which is what we're talking about here. In terms of, I'm talking about 100% equity banking throughout the whole system. But in any case, you're concerned because of specific actions that you've seen taken with respect to Treasury, OFR, agencies, the SEC, anything that is particularly of great concern to you that's happened in the last 6 weeks under this administration?
How much time do we have? I mean, there's a lot of things going on that concern me. As far as Treasury is concerned, having worked there, we have 80 years of public service in Treasury where trusted employees were delegated the responsibility to pay the country's bills through systems that were set up that controls $6 trillion of payments made out of the Treasury to the rest of the economy. Social Security, Medicaid, you name it. All those payments. And their sole job was to make the payments work. So it's like an accounts receivable operation. It has nothing to do with deciding who gets paid or how much they get paid. They just validated that the payments were to be made, and they paid them. And so, comes now Elon Musk, and he says, I'm going to put my people in, and we're going to get access to that system. Well, not only has that never happened before, but it threatens to undermine the integrity of the system and the information that is there about every person and every business in America. And am I going to trust a system that exposes my personally identifiable information, to people who have no business being there and who can use it for corrupt and illicit purposes rather? I think the answer is no. Now the court ruled that they don't have proper access to that, but we'll see, because the Secretary of the Treasury went along with this idea. And the guy who was in charge of the operation, who was a colleague of mine at Treasury, was put on administrative leave, and he subsequently resigned because he was being, sidelined and overruled in this. That's just one example of the concern that I have.
But they go to the, if we made that, I don't want to interrupt you, but just for a second, could they get into the system and say, well, Nancy Pelosi, we don't need to send her Social Security, she doesn't need it?
100%.
Could they start scrambling erase people's earnings history?
Yeah, people they don't like, they take, they there's retribution for them not being favored by the administration. And so
So,
what does that do? It creates fear. It creates lack of trust. It creates the, people who are absolutely dependent on those payments for a living. Then they submit. They bend the knee. And that's a dictatorship. That is not a democracy.
well, I've had a variety of people on this podcast in the last 10 days who are saying the same thing, that we're moving, this is a movement towards fascism. This is reminiscent of, and this will sound extreme, but if you look at the history of Hitler taking over uh, the German Republic and transforming it within a very short period of time into an autocracy, uh, what we're seeing today in so many different ways from this Trump administration, from Trump himself, is it kind of lines up one for one to a large extent with what the actions that Hitler took in the early days of his regime. And then, of course, we have it took Hitler I don't know, about 6 years to form the Molotov-Ribbentrop pact to divide up with Russia, with the Soviet Union, Poland. And here we have uh, Putin and Trump and Putin dividing up Ukraine within a few weeks.
And who's next?
Yeah, who's next? So scary times is what everybody is saying. And
And I agree with that. And, you don't have to go further than looking at the way that they are controlling the propaganda, excluding people they don't like from the press. Peter Baker of the New York Times said that this reminded him when he served in the Moscow bureau of exactly what Russia was doing to exclude people they didn't like from reporting on what their activities were.
yeah,
Very similar.
suing the press, leaving people out of the White House press room that they don't like. Yeah. So if you're a typical American household, you're hearing all this. Any suggestions for protecting one's wealth and money? Would you trust U.S. Treasuries? I've been suggesting to a lot of people up till now, up till Trump was elected, and when I started seeing what's going on, that they should think about long-term inflation index bonds. 30-year tips are yielding 2.4%. But now we have the concern that the CPI indexation of those tips will be manipulated by the BLS, where somebody who's appointed by Trump is screwing around with those calculations, and therefore people will not actually have inflation protection on these securities. Could it be that we actually have a default on Treasury bonds? Uh, how bad do you think this could get? Is everything open for ruination, so to speak?
Well, here's my hope.
Yeah.
Right? My hope is that, I would say if there were no hope, then you should be investing in a Swiss bank account or something, or, putting your money outside the United States if you didn't trust U.S. obligations anymore. My hope is that before we get to that point, that there will be recognition of the perils involved in what's happening now. And even the erstwhile supporters of this administration, if enough of them turn to protect themselves, forget about whether they're altruistic and they care about even their grandchildren or their kids or their constituents. If they care about themselves, then they may start to put up roadblocks to this, to what's going on. We'll see. It's been only a month, and already we're starting to see some cracks in that facade. So I'm willing to give it another few weeks, and see whether or not they respond.
Okay.
Meanwhile, I think it's best to be very prudent about investments and to avoid, taking more risk than you understand. Maybe
Well
that's
said.
a good place to leave it.
Yeah. Dick, Richard Berner, thank you so much. I will have you back to talk some more about where things are, hopefully they're in a better shape.
I look forward to it.
Let's
Thanks, Larry.
thanks so much. Take care.
Take care.